In this presentation, I'm going to be looking at question 216, Breezer Bakery. In the required, we asked to prepare the following general ledger accounts for the period 1st of January 2003 to 31st of December 2003 for vehicles, asset realization, depreciation, and accumulated depreciation on equipment. We also asked to prepare the note for non-current assets, that is PPE, for the year ended December 2003, and to show the disclosure of the non-current assets, that is the PPE, in the statement of financial position at the 31st of December. In the question, these two parts of the required are combined, but you will not be able to work out how much to put in the statement of financial position until you've actually finished preparing the note for PPE, because you will use this note to calculate the amount of the closing carrying value of PPE at the end of the year, which is then the amount we put onto the statement of financial position. In this question, or in this presentation, I'm only going to be looking at the equipment transactions. I will exclude discussion of vehicles. You're encouraged to finish the question on your own, including the transactions relating to vehicles. We need to prepare certain general ledger accounts before we start working. The three accounts I'm going to look at are accumulated depreciation on equipment. We're not required to do the equipment account itself. We need to do the asset realization account and the depreciation account. Remember, asset realization is a clearing account that we use to calculate profit or loss when we sell an asset. We also need to prepare the note for PPE. This format you need to study, and we are only in this presentation going to be looking at the column for equipment. We are given opening balances in the question. Equipment cost 128,000 and accumulated depreciation up till the beginning of the year is 36,000. We can put that information straight onto the first part of our note. The cost minus the accumulated depreciation is going to give us the carrying amount at the beginning of the year of 92,000. We can also put into our general ledger the opening credit balance on the accumulated depreciation on equipment account. We start with an opening balance accumulated depreciation on all equipment up until the beginning of the year is credit 36,000. If you now read the additional information, depreciation on equipment is 20% per annum using the diminishing balance method. They tell us on the 31st of March, equipment that had cost 18,000 that we had purchased on the 1st of January 2001, that's more than 2 years ago, it was sold at a loss of 2,444. So here we have a sale, we have a realization, so that tells us we're going to have to do the asset realization account, which we already know. It tells us we sold at a loss of 2,444. It also tells us that depreciation for the current financial period until the date of sale has already been calculated. Normally this is the first thing we calculate when we do realization, the depreciation for the current period till the date of sale. It's been done for us, and it's been done for the period from 1st of January to the 31st of March, which is the 3 months in the current year that we were still able to use this equipment. That would have been 3 months depreciation on the carrying value of the equipment at the beginning of the year. All other equipment was purchased at the beginning of the year, so all our equipment besides the equipment that we've talked about already that we sold was purchased at the beginning of the year, and that's good news because diminishing balance method, we need to look at the birthday of the asset, and in this case the birthday of the asset and the beginning of the financial year are the same, so we don't need to separate our depreciation calculations. When they tell us there are no residual values, that means our depreciable amount and carrying amounts will always be the same. And when they tell us that the equipment was available for use on date of purchase, that's important because if, for example, your date of purchase was earlier than the day available for use, you must use the day available for use to start calculating the depreciation from. So that's an important concept. You calculate depreciation from the date the asset is available for use. We can now put amounts into our general ledger accounts we're required to prepare. we put the 576 into the credit of the accumulated depreciation equipment account. This is 3 months depreciation for this year on the asset we sold, and we debit the depreciation expense account with that amount of depreciation. The 18,000 is the cost of our equipment we sold. We don't have to do the equipment account, but we would be crediting the equipment account and debiting the asset realization account with 18,000. They also told us there was a loss on disposal of equipment. That goes on the credit side of the asset realization account because we debit an expense account called loss on disposal of equipment. We also don't have to show that expense account, but the credit or the contra for that is here in the asset realization account. So we're still going to need to work out in our asset realization account what is the accumulated depreciation on this asset up until the date of sale. So we know what it is for the last 3 months, but in this opening balance for accumulated depreciation, we're going to have to calculate how much of that is relating to the asset that we sold. The final amount we're going to need to put in, the balancing amount in our asset realization account, will be the amount for bank. If we now create a table, on the 1st of January 2001, we put in the cost of the asset, and then we see for the first year of the asset's life, there was 12 months of depreciation. For the second year, 12 months. And then until the date of sale, in the last year, we have to calculate 3 months, and that's already been done. The amount 576 is given in the question. So we can now calculate the opening accumulated depreciation at the beginning of the year by calculating the first year's depreciation, which would be 20% on the cost. That would give us an amount of 3,600. So the carrying value of the asset at the end of its first year of its life would be 14,400 Rand. For the next financial year, we would calculate 20% now on the 14,400, and that would give us depreciation of 2,880. That 2,880 would reduce our carrying value now to 11,520 at the beginning of the financial year. The 2,880 together with the 3,600 now gives us the 6,480, which is accumulated depreciation at the beginning of the financial year. So the cost is 18,000 at the beginning of the year, accumulated depreciation 6,480. At the beginning of the year, the carrying value is 11,520. If we now look at the last 3 months, we already know the depreciation is 576. We would have taken 20% for 3 months, which is the equivalent of 5%, and we would have multiplied 11,520 by 5% to get the 576. So the 6,480 plus the 576 gives us 7,056, which is the total accumulated depreciation to the date of sale, and the 11,520 minus the 576 gives us the carrying value of 10,944 at the date of sale. So we now finally have the cost, accumulated depreciation to date of sale, and the carrying value. These two amounts, please remember, because we'll see them now in the question on the following few slides. So in our accumulated depreciation on equipment account, we are going to take out the full depreciation up until the date of sale on the asset we got rid of. We're going to debit the accumulated depreciation account and credit the the asset realization account with the amount of accumulated depreciation. In our asset realization account now, the only amount we still need is the bank amount. We know the loss on disposal of equipment is 2,444. So we're going to total the debit side of the asset realization account because the total is bigger. Take that across to the credit side, and the amount for bank will be our balancing figure. To calculate the amount we received, you can also think about it like this. The cost of the asset was 18. Accumulated depreciation to date of sale is 7,056. The carrying value is 10,944. We saw that on the table we did just now. So now if we take the 10,944 and subtract our loss of 2,444, it means we received 8,500 Rand. And that 8,500 Rand is the balancing amount on the asset realization account, which we will then debit to the bank account. On our property, plant and equipment note, when we do the movements for the year and we show disposals, we're always going to show this at the carrying value. Please show your calculation. This is cost minus accumulated depreciation to date of sale. The carrying value gets subtracted, because remember, we're starting with carrying amount of all equipment at the beginning of the year. We're subtracting the carrying amount of the asset we sold. We also end with the carrying amount of the remaining assets at the end of the year. So if we now look at this 10,944, remember, that's the carrying amount of the asset that we sold, that we just put onto the note for property, plant and equipment. In the question, we are now going to be looking at the assets that were purchased, all the other equipment that was purchased that wasn't sold, and we have to calculate depreciation. So the cost is 128,000 of all equipment. That includes the equipment we sold. So we're going to subtract the 18,000 to get the cost of the remaining equipment that we didn't sell. The accumulated depreciation was 36,000 on all equipment at the beginning of the year. At the beginning of the year, in the opening balance, there's depreciation of 6,480. That 6,480 must get subtracted, and we get an opening accumulated depreciation amount on the remaining equipment of 29,520. So our opening carrying value of all equipment is 92,000. At the beginning of the year, not at the 31st of March, at the beginning of the year, the carrying value of the equipment that we do sell on the 31st of March, its carrying value at the beginning of the year is 11,520. So these amounts are before the 576 Rand depreciation for the current year. So we're subtracting the amounts at the 1st of January because these balances are at the 1st of January. Now we have the balances at the 1st of January for the equipment that we didn't sell. So to calculate, here's the 6,480 that I just talked about. That was the accumulated depreciation on the equipment that we sold at the beginning of the year and the carrying value of the equipment we sold at the beginning of the year. So to calculate our depreciation amount for the current year on remaining equipment, we're going to take 8,480 and multiply it by 20%, because this is diminishing balance method, and that's our diminished balance, and with that, which is the same as our carrying value in this question, because there's no residual value. So the depreciation on remaining equipment is 16,096. That means the accumulated depreciation on the equipment that's left at the end of the year is 45,616. That's the beginning of the year balance plus the depreciation for the current year. This is only on remaining equipment. So if we take the carrying amount of the assets that weren't sold at the beginning of the year, subtract the depreciation for the year, we'll end with a closing carrying value of remaining equipment of 64,384. You will see these amounts just now on the note for PPE. So we're going to put through in our general ledger the depreciation on the remaining equipment. We're going to credit accumulated depreciation on equipment. Remember, this is a negative asset. The credit reduces our cost to get down to carrying value. We're going to debit our expense depreciation. So now we have the depreciation on the asset we sold, and this is depreciation on the equipment that we didn't sell. So now if we balance our accumulated depreciation equipment account, the credit side adds up to 52,672. If we subtract the 7,056, which is the accumulated depreciation on the asset we sold, we're left with a balance of 45,616, and that's familiar to us from the table we did previously as the accumulated depreciation on the remaining equipment at the end of the year. In our depreciation account, we have total depreciation expense on equipment for the year. So if we put this now onto our note, here's our depreciation expense for the year, which comes from our depreciation expense account. depreciation on the equipment we sold, plus depreciation on the remaining equipment. You'll also see that I can now calculate my cost at the end of the year, because it's the 128,000 minus the 18,000, which is the cost of the equipment we sold. Giving me 110,000 is the cost of the remaining equipment. This accumulated depreciation amount is the balance in my accumulated depreciation on equipment account. I can also calculate that amount by taking my opening balance on accumulated depreciation, adding the depreciation for the year on all equipment, and then subtracting the depreciation, the accumulated depreciation on the asset we sold, and that will also give me 45,616. Please, when you do this note, show as many of your calculations as you can. So the 64,384 is the carrying value of the remaining equipment at the end of the year. So at the bottom of our note, you will see cost of 110,000, accumulated depreciation 45,616, and carrying value of equipment 64,384. And you will see on the bottom of the note for property, plant and equipment, cost minus accumulated depreciation, giving you carrying value of 64,384. Those are all the transactions relating to equipment. I also spent some time in class using percentages to do the calculations, and I want to discuss those now. So if we do a similar table now, but we put in our cost and we say that that represents 100%, and we again have the 12 months for the first 2 years and the 3 months for the last year, and the depreciation for those 3 months, then what we can do is the first year depreciation is 20% on the cost price, so we subtract that to get our carrying value at the end of the year, which represents 80% of the original cost price, 80% of 100%. So depreciation for the first year is 20% of cost price. In the second year, depreciation is 20% on our carrying value, so we take 20% times 80%, which is 16%. That leaves us with a carrying value of 80% times the 80%, which is 64%. 64 plus 16 gives me 80. So I've taken the carrying value, 20% is written off as depreciation. That leaves me with 80% of this carrying value remaining. This 64% is the carrying value of the original cost that hasn't yet been written off and is going to be written off in the future. The 16% is the current year's depreciation based on cost. So that 16% is 16% of cost that's written off as depreciation. It's the 20% of the 80% carrying amount at the beginning of the year. This means that if we add together 20% on cost plus 16% on cost, total accumulated depreciation until the date of sale is 36% of cost price. Total carrying value at the date of sale is 64% of cost price. This is the amount that hasn't been depreciated yet. We can now use these two percentages to calculate our accumulated depreciation and carrying value. These amounts should look familiar. If we take 36% times 18,000, that will give us the accumulated depreciation up until the beginning of the year. And if we take 64%, which is the carrying value we haven't yet written off, times 18,000, it gives me the 11,520 carrying value on this asset at the beginning of the year. I know that for the next 3 months, depreciation is 20%. If we take that for 3 months, it means we're using a rate of 5%. So another way of calculating this 11,520 carrying value at the end of the year is to take this 576 and say that represents 5% of this carrying value amount. So we call this 5% and this 100%. 576 divided by 5 times 100 is going to give you a carrying value of 11,520. In your official solution, they give you this 11,520, you know the 18, so the accumulated depreciation is the difference between the two. So this is the quickest way of getting to the opening accumulated depreciation, is to work out what this carrying value is by taking this depreciation and dividing by 5 and timesing by 100. We can now put in the closing amounts at the time we sell this asset. So that means our total accumulated depreciation increased to 7,056 and our carrying value decreased to 10,944. And these are the amounts that we've already used in the previous part of the question. The point of what I've done here is that you need to understand when you're doing depreciation, what your depreciation is as a percentage of original cost price. And when you're using diminishing balance method, it means you're calculating depreciation each time on a reduced balance. So that means the amount of depreciation on cost price every year will go down. And this was useful to us because it meant that then was the percentage of the original cost price that had already been written off, and that was the percentage that was our carrying value.